Now let's meet our two presenters. Colleen Tate works with MNP's Assurance and Accounting team. Now she leads their national food and beverage and also Alberta's poultry team. Also, we've got Alex Strachan out of Winnipeg. Now he's a senior farm management consultant. He works one-on-one with farmers and agribusinesses, both strategic and financial planning, everything from feasibility study to benchmarking, cost of production. We have a great team with us today to really cover this topic around financial literacy, forecasting, understanding your numbers. So with that, I'm going to turn this over to Alex to get us going. You guys have a great day, a great hour spent with us. And Alex, take it away.
Fantastic. Thank you, Lane. Okay, so let's get underway here. Today we are covering, I guess I'm on the wrong slide even to start, financial position and projections. So what does that mean? We've been covering over the number of webinars we've been doing so far, kind of how to create a business plan. And we've kind of taken some high-level approaches, looking at kind of bigger picture type things, down to some really kind of difficult to do exercises. So today we are focusing on our projections and financial literacy. So we always talk about our roadmap to success. And we always say, who, where, and how. So today you are the who. Where are we going? That's kind of the abstract part of this exercise, which will be fun to be a part of. And the how will also be covered as well. So what does that look like? So we've said across all of our webinars here that when we're looking at business planning, we have to answer those questions. So when we talk about the who, the where, and the how, who are you? So what that means is, well, what do you do? Why do you wake up in the morning? What is your operation set out to do every day? And then where do you want to go? We covered a lot of this in our mission and vision statement exercises and webinar. I believe that was 2 or 3. And how do you get there? Again, a little bit more of the goals and objectives type webinar that we covered off. So all of these things really kind of come together as a whole. So you can really watch any of these webinars in any order, and they still all go together quite well. Really, what we want to cover off today is financial statements and essentially how to make projections and do some assumptions. So before we get into that, I want to do a quick refresher. These all of the themes we've covered in these webinars have all kind of come back to our SWOT analysis. So for those of you who have tuned in before, this is a great time to maybe grab that second cup of coffee. For those of you who haven't, well, I'll do a quick overview of what we covered off kind of over the last few webinars here. So our SWOT analysis is really just an exercise of understanding the strengths, the weaknesses, and the opportunities and threats of our operation. So really, a lot of what we talked about in our SWOT analysis, which was webinar 1, they really contribute to the important topics we've been covering throughout. So when we go into our, our second webinar there, the risk and identification and evaluation, we talked about how we can use our weaknesses and threats to mitigate potential risks to our operation. So we really focused in on, what could we improve on? Where do we have less resources? What are some things in our industry that might be, posing some risks to us? So that's kind of the external view of that, whereas, the weaknesses or the strengths in the top are more internal looking in. So as we go through, we also covered our strengths and our opportunities. That was more geared toward our goal setting, our mission and vision webinars. A lot of these things that surround our strengths and our opportunities really focus on what we do well. How are we different than somebody else who's doing something a little bit similar to us? And, what is out there for opportunities? Is there a trend in our industry that we can take advantage of? And how are we turning our strengths into opportunities? So this is where it's really important when we covered our mission and vision section, where it's a little bit more abstract, but it really does help really bring it all together to be able to really focus in on what's important. So when we covered off our goals and objectives, we really talked about the whole SWOT analysis, right? There's strengths, there's weaknesses that we can associate goals with. with what we're good at, what we want to continue to be good at. And we mentioned that our goals need to be SMART goals. So that would be specific, measurable, attainable, realistic, and that has a time frame on it. So these are all things that we need to focus on when we're talking about our business plan as a whole. So where are we going? How do we want to get there? What are some milestones we've set for ourselves? Who is a part of that? And now, what does that turn into on from a financial standpoint? So you can kind of start to see where all this is coming together and coming to an end, where really it's saying, okay, that's great. We've done all these exercises. We've put some pen to paper. We've put in the effort. Now what? So when we're talking about a business plan, we really want to start looking at our financial position and how we do that. So this section of our business plan really allows us to measure the impact of our goals and objectives. So if we set out to increase profitability by 10% per acre, okay, great. So how does that look in the grand scheme of things? In our financial position or projections, where we look at our year-end statements, it helps us reflect on whether we stay true to our mission and vision, or did we maybe go down a different path? Or are we straying from our original thought? Or are we trying something new? So these are all things that are important as well to look at when we're talking our financial statements. And so when we're looking at our financial statements and maybe some financial projections, we really need to have a good understanding of what goes on in our operations. So I have here on the slide, have a deeper understanding, but I think that can go two ways. It can say we want to develop a deeper understanding, or we need to have a deeper understanding to be able to see what goes on. And I think both sides of those are okay. But I do think that to be able to put together a impactful plan or projection, you do need to know what's going on in your operation and what things can really make other things change. So that kind of brings me to my next point of we need to celebrate our successes. So if we set out to hit a certain revenue goal or manage, expense line item A, let's celebrate that if we hit our goals, right? These are things that we can look back and say, hey, we did do what we said we set out to do. And that's really, really important. And on the flip side, this allows us to also look at areas for improvement. So if we set out to do a goal that was maybe financial based and we didn't quite get there, what was holding us back? Do the numbers tell the story? Was it maybe something we need to focus on internally? It could be a bit of a combination of both. Usually it is. So if we were worried about maybe the cost of an office party, well, that's okay. We want to continue to have those, but as an example, that line item on, say, office celebrations or whatever it might be, I mean, it's not necessarily related to maybe the operation as a whole, but if it was part of your goals to have, good employee retention and engagement, then these are things that need to balance. So as a whole, we need to make sure we're reflecting on our financials, but also being able to properly look forward and create a plan. So things to consider. When we're thinking about the financial positions section of our business plan, we really have to look at these three things that I have up on the screen right now. So why is financial reporting, oh, sorry, I skipped one. What does your financial statement really show you? And we kind of covered that on the last slide of, well, what went well? What are we missing maybe? What is pretty status quo? And where are there opportunities for change? And then why is financial reporting really important? So we'll get into that a little bit deeper here next. But really, I want to outline the importance of understanding what each of the sections of your financial statement is and what it's trying to tell you. And then also, what are some key stakeholders that you're going to be looking at when you're looking at your financial statement? So these can be internal stakeholders, external stakeholders like the bank. These can be, if you're part of some kind of benchmarking, there's going to be different aspects to what people are going to be looking at. And it's not always just a straight line item. It's sometimes how different line items interact with each other that really is important to focus on. Okay, so recommendations for today. 3 ways to get the most out of this webinar. I would say if you have your own financial statements on hand, could be this past year's, could be the one that you can find the quickest, whichever. Just to be able to kind of say, okay, well, we start covering off a few topics, you can start to look at your own and see how you stack up and maybe ask some questions on it at the end. There's a FCC's sample business plan as well on their website. That would be good to follow along. We have a couple examples from there. And also downloading the glossary for the complete list of terminology used in our webinar here today. So these are all little things that we can get the most out of this webinar today, but if we don't have those handy, just follow along and hopefully you can take something from this and bring it back to your operation. Okay, we are going to get right into it. So right to the financial statements. So we're going to start off with number one here. What does your financial statement show you? Okay, and so we're going to start off with a poll, and I wanted to ask the group if they knew if their financial statements were accrual statements, cash statements, or I have no idea. So I'll leave this poll open for maybe the next minute or so, and we'll see what comes through. I'll give maybe another 30 seconds, a minute to make sure everyone can get platform open and get their votes in. Looks like we have a few answers coming in. I'll give maybe 15 more seconds for everyone to get their answer in. And it's okay if you have no idea. That is okay. That's what we're here to talk about today. So I won't single you out. Be honest. Looks like we have a bit of a mix. Okay. So there was no right or wrong answer in this one, but I really wanted to explain what the difference was between a cash financial statement and an accrual financial statement. So the difference between the two are actually, they're pretty, it can be a little bit confusing because for accounting purposes, we typically look at statements on an accrual basis. And so what that means is we need to make adjustments to be able to reflect things that happen during the fiscal year and put them in that year. So they really have to reflect the revenues and the expenses pertaining to that year. So not necessarily the revenue and expenses that actually occurred. Now, that sounds like crazy talk. Sounds like crazy talk what I just said. But think of it this way. If you're a crop or a grain farmer and you seed some stuff in, this spring coming up. So it's the year 2024. Okay? And so we've got our crop coming off in the fall. All things go as planned, but we deliver grain on December 31st to the elevator this year, and we asked them to, can we get paid tomorrow in 2025? Because I want to push that. I don't want to take that income today. So if I deliver the grain on December 31st of 2024, and I get paid in 2025, what happens? Where does that income go? Well, the year that the crop was produced, that would happen in 2024. Even though in our bank account, we don't see that check hit our bank account until January 1st. So this is where I start to lose people because they said, well, hold on. The check never cleared until January 1st. How can that be part of 2024, the year before? Well, it's because the commodity that was produced in 2024. So we try to really reflect in accrual financial statements what happened during the fiscal year. So if all that crop was produced, it needs to be accounted for in that year. So it goes the other way as well. So I've got a little bit of a tricky one that we haven't quite covered off yet, but I've got another poll. But the next question is a bit of the opposite. So we see this a lot with prepaid fertilizer. So if we were to pay in advance for the fertilizer, say in the fall of 2023, for the 2024 crop, where does this expense show up on our accrual financial statements? Will it show up in the year I paid, following year, the year after that, or are we not sure? The poll should be open, and go ahead. I'll give you a minute. Okay, it looks like we just got our poll launched here, so let's give us maybe an extra minute here to answer. So just to go over the question again, the example is we bought fertilizer in the fall and we paid for it, so we wrote the check in fall, but it's for next year's crop. Where should I show this expense on my financial statement? Seeing lots of 2024. That's good. Okay, so the answer is in fact 2024. So I kind of set that one up a little bit easier, but it's on the expense side of things. So again, we wrote the check, so the cash goes out of our bank account in 2023, yet we don't actually incur it as an expense until 2024. The accounts do a little bit of playing around where that cash does leave the bank account, so it deducts our cash balance on our balance sheet. Then they put it as a prepaid, so it's still an asset that is on our balance sheet, and so it just moves things around a little bit. So this can get very confusing for folks who are in the agriculture industry, because we do your business tax on a accrual basis, but your personal tax is on a cash basis. So what I mean by that is taxes are done basically January to December. So whatever cash came in and out, that is what you're taxed on. But when it comes to your financial statements, we actually have to do some adjustments to take out everything that wasn't pertaining to that year. So it gets a little confusing, but bear with me. Okay, so the next part here, we are going to cover off why is financial reporting really that important? So there's a lot of reasons why it's important. Because you need to know where you're at. B, others typically want to know where you're at. If you have a loan with the bank, they typically like to see how their investment is doing. If they have $1 million loan out there, they want to know that A, you're able to repay it. B, maybe if you're doing quite well, they want to be able to help you with the next best thing. So this takes us to now balance sheet and income statements. These are parts of the income state or the financial statement that, if you read through it really quick, yeah, it all looks good, it's fine. But do a lot of us really know the difference between the two? And so part of it, we call one of the, we've got a little poll coming up, so I don't want to give away the answer, but between the balance sheet and the income statement, one of them we call it kind of is the movie, and one is a snapshot in time. So I'm going to go right up to the next poll here, and I'll go through maybe a bit more in detail once we go through it. So the difference between an income statement and a balance sheet can be thought of as the difference between a movie and a snapshot in time. So which part of the financial statement would be considered the story? So the snapshot in time versus the movie. Would that be the balance sheet or the income statement? Give one extra, maybe 30 seconds here for everyone to get their answers in. Okay, it looks like we have mostly everyone's answering some balance sheet. We've got a couple going to the income statement, but the majority we have on the balance sheet. So I'm gonna go back a slide, and I'm gonna go back to our kind of visual here to help out. So the answer was the snapshot in time, the story was the balance sheet. So why we call it this is that the balance sheet really reflects where we're at year end. So what are all of our accounts looking like? So that's our, our cash, so our bank accounts, what are our loans at? What are, our next payments for the next couple of years, for the next year looking like? What do we have on accounts receivable? This is on year end at say December 31st, this is what these look like. So it tells you a story, but if we wanted to see what happened kind of once we open the book or start the movie, the income statement really starts to take you through what happened throughout the year. So what came in for revenue? What happened for expenses? These are totals, not whereas the balance sheet is more opening and closing balances, hence balance sheet. So the reason why I like to call the income statement the movie again is because you can go through it and kind of understand, okay, so we had lots of revenue or less revenue than last year. Then you can go down the line and start to see how the year is shaping out. You go back up to the balance sheet and say, well, what does it all mean? Where am I at? So this is a really good analogy for those of you who maybe are struggling between, balancing or figuring out which one is which. Think of it that way. Okay, so again, why are these financial statements so important? Why do we have a whole section on it today? So we said they really help us identify areas to focus and improve on, right? So it helps us think critically when you see what's on your financial statement. It's not always necessarily about what we can improve on or what are we doing poorly, but it more identifies areas of focus that we should be maybe switching to. So if we think that something looks a little out, well, the fact that you even caught that is saying that you're focusing in on certain aspects of your financial statement. So really, if you say, well, we did X really well this year, or we had set out to reduce or improve this last year, and this allows us to say, well, did we? Did we not? Right? And some things kind of are about balance, right? So if we bought a whole bunch of new equipment this year, or last year, I should say, assuming our books are done, if we bought a bunch of new equipment last year, we would probably expect our repair bill to be lower than the year before, right? Newer machinery, we're hoping that there's less fixes, day in, day out. So that's something we can say, oh, hey, look, our repairs did go down this year, and that makes sense. Or, hey, why did our repairs stay so flat even though we upgraded all of our machinery? That maybe is it something to focus in on? What's going on? How are we running this machinery? Maybe is it worth talking to the dealership? So these are all different things that you can look at on your financial statement. So when we do identify an area of improvement, we have to really start to think about, well, how does this really fit into our business plan? So when we start looking at it that way, we have to go back to the drawing board, right? So we say, oh, we want to reduce repairs and maintenance. Okay, fine, go for it. But we need to understand what that actually means and how that fits in with what we're already doing. So if we're hoping to be if we're hoping to be sustainable, conscious of our spending, and it's our belief we want to run 10-year-old machinery, well, how can we reduce repairs and maintenance costs? Is it doing them in-house? Is it hiring, an experienced mechanic? These are things that maybe you can do a bit more in-house. But again, does it fit into your plan? If your mission and vision is to only hire people in the family, but no one's experienced in being a mechanic, maybe that type of plan doesn't really fit in, or it's time to maybe switch things up a bit. So what actions are we going to take? This kind of fits into that last example of, well, what are we going to do about it, right? Does it fit with what we're doing already? Are we on the course to be able to do that? And so what are we going to do? So we take this piece of thinking that, and we put that into our projections. So when we start looking a bit more forward and saying, well, we want to start projecting, for me, for the bank, what if we change this? What if we change that? These actions that we're going to take, we have to be able to quantify them and understand how these actions will affect our overall operation. So that takes us over to our projections. We're getting right into it. So what is a projection? These are financial projections or statements that we create that show us the impact of our mission and our goals going forward. So in our business plan, we use these projections to show if we set out to do this goal in this way, what does that look like from a financial and operational standpoint? So what does that look like? Does that mean we're spending more in some areas? Will it create more earning power? And what else does that look like? And the bigger question is, do we like what that looks like? So if we're looking at buying out the neighbor who has, 500 acres of land up for sale, we pencil it out and we say, okay, well, we actually need to buy more machinery if we buy the neighbor out. Okay, so we're going to earn more dollars to get more acres, but we're going to be spending more. Do we like what that picture looks like? Does it make sense? So when we start looking at projections, we have to put in assumptions because we don't know what's going to happen, right? And so when we make our assumptions, we really have to lean on the knowledge that we have of our operation to do so. So we have to be able to build in new plans. So if we have new plans to, like I said, add more acres, maybe put on some more machinery, maybe we're diversifying, maybe we're going to try out chicken farming. But we need to, essentially, we need to lay out what these increased revenues and expenses that are related to those increases. And if we don't do that, consciously, it could be misleading. So if we think that adding 500 acres of land isn't going to increase our seed fertilizer costs, I mean, maybe you're planning on doing a different soil plan than last year, but overall, those are things that you need to understand. That okay, well, what will the rotation be? What are the revenues associated with that rotation? How much more time will it take? Will it take more labor? Well, it's going to take more fuel. Do I need some help? These are all things that we need to build into that kind of plan to be able to show what these impacts of these different scenarios can be. So overall, we have to say what will change and what do we need to key in on. And the biggest thing I'll say here is that we need to be realistic with these assumptions. Your targets need to be attainable and not necessarily one-offs. You'll find that if you promise the bank 5 record years in a row with no problems, hiccups, or shortfalls, but then you fall flat 4 of the 5 years, generally speaking, the bank isn't going to be very happy a year or 4 years in saying, hey, you said you were going to have these awesome years because you did X. We haven't seen any of that. So generally speaking, you want these assumptions to make sense and realistic on your operations. That doesn't mean that you can't set, stretch goals, but when you're doing a projection, you want to see what a typical year would look like. You could be hopeful. You can say, oh, I think we're going to get 40 bushel beans every single year, but for some areas, that might not be realistic. Maybe on average, you get 35, you add a 45, maybe a 37. So, there's different ways that you can put these into your projections, but just know that it's better, you'd rather surprise yourself and the bank on the better side than to be overly aggressive and promise too much on your projections. Okay, so that takes us to our poll number 4. Right now, do you currently do any financial projections for your operation? Yes or no? Okay, a little bit of each, it looks like about 50-50 so far. I'll give it another 10-15 seconds here. Okay, so it looks like a bit of a mixed bag, and that's completely great. So what I will say is, it's all good. If you do them now, great. Hopefully you can learn something today about, maybe a different way of doing it, or just some little takeaways you can have to make your projections a little bit stronger. And if you don't do projections today, well, then we've got some great tips for you to get started. So tip number 1, again, we said key in on a few items that will make a difference. It's really, really, really hard to get a projection right and realistic if you're changing everything, right? If you're going to sell all your equipment and do custom work only and then fire everybody on the farm, but then hire students in the summer and then also do a chicken barn? There's a lot going on. Let's focus on a few key things. So, okay, we bought acres. Now what? Do we have the machinery base? Yes. Great. Let's make an estimate of, what we're currently spending per acre, maybe on machinery, repairs, fuel, labor, if that's your operation, time, and then try to extrapolate that kind of generally on those acres. So that's one example, but let's keep in mind that we have to remember what areas have we set out to improve on. So if we set out to improve on efficiency of our fertilizer plant, well, we'll probably see a little bit of an uptick in spending on soil testing. Maybe we'll see some savings on fertilizer, avoid over fertilizing, and maybe we'll see the impact of that. And if we do think that we're going to see a reasonable increase in yield, great, we can put that in our projection as well. So something I really want to emphasize on this part is it's not always about cutting costs, right? Your accountants often will say, we need to find a way to bring these down. We see this coming, we see these expenses going up and up and up. That's okay. It is okay to be sensitive to those things, but it's not always about cutting costs, especially when you're doing a projection. Often projections come about when you're looking to change something. So again, I always touch on repairs and maintenance because it's always, everyone does it a little different. But the fact that people say we need to cut down on repairs and maintenance isn't always relevant to everybody. Some have older stuff, they actually like doing the repairs on their own. Others prefer to purchase new equipment, having higher debt payments, but not having to worry about doing repairs at home, flipping them every couple of years. Your style is your style, but keep those assumptions in mind when you're layering that into your projection. The next thing I'll say, tip number 2, is you have to understand your operation in regards to the industry you're in. So what areas are you different than your industry might be? And if you don't know, we should revert back to our SWOT analysis and identify areas of your industry that you need to better understand to run your business. So if you are a poultry farm, and really the best thing if you're in supply management, really you're focused on efficiency, production, and cost management. So if you're setting out to be the highest revenue generating chicken farm, that can be a little bit difficult based on your quota allows you to ship what you can. There definitely are other ways to improve that, maybe some premiums along the way. But overall, if you have this massive revenue target that doesn't seem reasonable for your industry, it's good to understand kind of what industry you're in and how that might look. So again, revert back to your SWOT analysis. Where do you stand? What are some things that are going on in your industry? Okay, and then number 3, we've kind of touched on this before, is using the projections to summarize the impact of our goals, our assumptions, new project, and our management. So as we mentioned before, this is how you can determine what impact that achieving and working towards your goals will have on your overall performance. So if you're hiring new people, maybe labor will increase as a cost, but you also might see improvement in other areas such as reduction in custom work. Maybe you'll see maybe a lowering in overtime payouts. So these are things that you have to understand kind of the effect of what you're changing in your kind of modeling for your projection here. So if you're adding acres, you might see higher interest costs if you took a loan from the bank, higher fuel costs, higher input costs, but maybe you don't need to buy more machinery. So maybe your overall efficiency on that front will improve on a per acre basis, but the total number might still increase. So overall, these are a couple things that, again, when you make an assumption, figure out what that chain of events or chain of things will happen afterwards when it comes to your financials. Last one, revert back as you go. I've seen this time and time again where you drop a good plan, you're all excited about it, and then it sits on the desk until next year and you say, oh, wait a minute. What did we set out to do again? What did we do here? We said that we were going to make all this money, but I don't remember how we said we were going to get there. So it's okay to go back and revise assumptions if plans change. So if the neighbor was selling 500 acres and you put that together and they said, you know what, I think I'm going to do 800. I think I want to, buy that house in Arizona, for my retirement, or I want to buy a bigger one. Who knows? It's okay to revert back and say, well, what changed? Well, let's see if it works with more acres. Can we afford the payments? Does that push us into a position where we need more labor, more machines, more help, or anything? So these are things that it's okay to look back and go back and say, hey, something has changed. Let's make an adjustment. Reverting back isn't always about making changes either. It's about also holding yourself accountable. So if you set out to make a change and you put that into your projection and you hope to see its impact, if you're halfway through the year and you kind of run some numbers and you aren't really seeing that impact, are you really doing what you set out to do? And look back to see where you're missing your mark, or to see if really that goal was even attainable in the first place. So these are all things to keep in mind. Okay, so a couple other pieces of kind of a little tips for making projections. It's important to understand our efficiencies. So I've covered that in a few examples, so I won't spend too much time on these 3 bullets, but your input efficiency, your machinery efficiency, and your labor efficiency. So when we're budgeting, we want to understand what our farm's mix is like. Not every single farm will have the same breakdown for how much labor they use, their machinery. I've kind of beat that one to death a little bit, but these are things that it's okay to be different than somebody else. Input efficiency, I kind of touched on that with some, maybe if you have a livestock operation or a livestock operation nearby, maybe you put down manure, and that helps with your fertilizer bill. So just understanding how your farm or your operation differs from others and how you're unique, these are things that you have to understand when you're doing your modeling as well. And what kind of doing these types of things allows you to do is it allows you to benchmark. So really, once you kind of have your numbers all set and you understand them, you understand how to benchmark against yourself. So year over year, quarter over quarter, maybe within peer groups, so neighbors, or maybe a more formal peer group. But when you're talking with friends or family or neighbors or coffee shop, ensure you're all talking about the same accounting methods. Track the items in the same manner. So we see this all the time. We see someone who says, "Oh, I had a really terrible year. I have no money in my bank account," but really what they mean is they have a whole bunch of grain on waiting to get paid for at the elevator, but they just feel they don't have any cash at the moment. So everybody's story is a little bit different. So keep that in mind. Okay, so a little bit of an example here. For those of you who maybe this is a little smaller, essentially what we're covering here is an example of a projected income statement or an income statement. This is directly from the FCC sample business plan. So if you have that handy, follow along. So on this income statement, we call this the movie before. And so what we're going into here is at the top, we see what our income was for the year. So cropping, every accounting firm will have this looking a lot different from one another, but generally speaking, we have our income. We have some rebates. You have your co-op checks that come back. Maybe there's some lease income there as well. So you have your total farm income on that kind of top summary line. Then maybe there's some inventory adjustments. That would be our accrual. Doesn't look like we have that in this modeling here. But on the crop we do. So if you want more information on kind of how that accrual adjustment gets done, you can definitely reach out. Then we have our expenses. So again, these are expenses that occur in that year. So we have, all of your overhead expenses that aren't directly related necessarily to the crop. So we have our property taxes, utilities, interest, all of our cash expenses, we call them. Depreciation, it's an accounting term that basically writes off your assets for you to be able to expense them. And then it basically gets you down to your total expenses and then your total net income. So your net income would be your revenue minus your direct costs minus your overhead expenses. So as we go through this, we talked about, well, who's going to be looking at this, right? And so who's going to be looking at it and what do they look at? So something that's a bit more maybe tricky to, to grasp here, this is easier if you have maybe the sample business plan in front of you or your own. But we're going to get into a few ratios that bankers and that managers typically look at when looking at financial statements. The first one, I'm sure some of you have heard this before, is our current ratio. So our current ratio is our current assets divided by our current liabilities. And so our current assets are assets that will be turned into cash in the next 12 months. So that can be cash, accounts receivable, prepaid expenses, and well, I guess if you had a short-term investment as well, there's a whole number of things, but these are your inventory. So these are things that can be turned into cash pretty much instantly, or that will be turned into cash in the next 12 months. Liabilities that are current are the opposite. So these are things that we owe or that need to be paid in the next 12 months. So your operating line is considered a current liability. It's expected that you pay that back. It's not a term loan. Accounts payable, same idea. So these are things that basically you owe in the next year. So the ratio is, well, the ratio between the two. So typically we like to see a ratio of about, 1 point, well, depends on the type of operation you are. Some operations require maybe a 1.5, 1.2. It's a little bit trickier where a standalone crop operation, typically we like to see a bit of a higher current ratio just because they only have one revenue cycle per year. Whereas a livestock operation, they have money coming and going every single month. So we like to see this as a bit of a war chest to say, well, if push came to shove, what's our ratio? Something important to note, current ratio isn't necessarily everything. So working capital is also a very, very important thing to be looking at. So this is your current assets minus your current liabilities. So why does this matter? Essentially, this is the surplus that you would have available after covering your short-term liabilities. So we talked about having a good ratio is very important, okay? But what I like to say is the ratio is irrelevant if there's not a lot of dollars there. So I might have $50 in my bank account and I only owe $1 to the neighbor this year. So it's a 50-to-1 ratio. I've got $50 of current assets to my $1 of current liabilities. But that means I only have $49 to cover off any other expenses that I might have. So I like to see this as like a war chest or an emergency fund. So I typically, on a grain farm especially, we like to see, a working capital, a strong working capital would be about 50% of next year's expenses. So if your labor, power, and machinery costs, if those are, or your overhead costs, if you want to call them that, if they are $1 million, I'd like to see you have $500,000 of working capital available. Just as in case of an emergency, there's a big crop failure, waiting for your crop insurance, you still can service your kind of short-term liabilities and then also take care of some of the expenses to keep going. Hopefully that makes sense for everybody. And again, if you have any further questions, reach out. We can definitely kind of have a sit down and have a session, or you can also talk to anyone in your FCC team as well. So there's a couple metrics that you might hear floating around that really can go in your industry. So I'll go through them quickly. We have our, in grain, you often hear gross margin per acre, net income per acre. On, a dairy, you might hear feed over revenue, debt per kg. Hogs, you might see revenue per hog, gross margin per hog. On a feedlot, you might see cost per pound gained, cost per head per day. These are all things that they seem, if you're in it, you probably hear this all the time, but these are metrics in which you can kind of benchmark yourself and against others as well. Another common term that I wanted to make sure everyone knew what people were talking about was when people are talking about EBITDA, that is basically your earnings before interest, taxes, depreciation, and amortization. So why is this important? Essentially, it represents the cash profit generated by your operation. So it's your net earnings. Then you have to add back your interest, and I'll tell you why after. Your depreciation and amortization, those are kind of non-cash items. You're not actually writing anyone a check for that. It's an accounting strategy, not strategy, it's accounting thing that basically lets you write off your assets gradually versus actually just write them all off all at once. And then when you add back in your interest, it allows you to kind of have a true reflective available cash to pay for things, which takes us into our next ratio. That this one might be one of the be all end alls. So our debt service ratio is equivalent to our EBITDA. So that's our cash available from operations after we add back our depreciation, amortization, interest, and taxes. And then we divide that by our principal and interest payments. So why do we do this? This essentially shows you the ratio of how many dollars you have to pay debt for every dollar of debt you have. So the reason why we would add back our interest payments is because, well, if we weren't adding those back, we'd be double counting them and it wouldn't be able to be servicing the payments that we have kind of down below. So typically from a debt service ratio, we like to see 1.1 to 1.5. It depends on the industry, but this number, typically the bigger the better. The higher, the more dollars you have to pay for debt than you have of debt is typically better. That being said, if you just had a big new loan and an expansion, a buyout, whatever, this number might be a bit more sensitive and closer to 1.1 or 1.0. Whereas if you're almost at the end of your loans, it's likely of a very, very large number. That means you have room to take on some more debt and grow the farm. So when we go back to our example on our income statement here, you can see our net earnings. We'll start maybe in the 2015 column. We have, I guess I should have pulled out a calculator. Okay, so we have our net earnings of $165,759. We would add back our depreciation, $92,959, and term interest of $58,194. And we don't take out property taxes. For those of you who are wondering, what taxes do we take out? This is an income tax number. Property tax is part of our operating costs that we need to leave in there. So in this example, our EBITDA would be $316,000. All right. So that brings us into our Q&A section of the webinar. So Lane, I'm not sure if you saw any questions pop up during the presentation or if you had some of your own, but we'll open the floor to any questions. Feel free to type them in the chat.
Yeah, you bet, Alex. Thank you so much for that. Actually, we do have a couple questions here, so I'm going to get right into them. But if other people have questions, please, by all means, I'll be watching for those as they come through. So the first question was asking for a bit more clarity or just maybe a quick recap on movie versus story, balance sheet versus income statement.
Sure.
If you could just, spend a minute or two on that.
Sure thing. Okay, so I'll start with the income statement. Actually, I'll go back a couple slides so I can kind of illustrate this. Okay, so our income statement, this is the movie because it basically tells you from start to finish what all came in terms of dollars and what all came out. And so you can start to see, I mean, this one has a little bit less detail. If you pulled up, some accounting firms have a bit more detail. This was a projected one here, but essentially this is the movie because from start to finish, you can see all the events that occurred throughout the year. And by events, I mean, well, where did I write checks? So, hey, spend $5,000 on property taxes, $2,000 on telephone. My long-term debt, the interest on that was $60,000. So you can really start to see kind of what's happening throughout the kind of the story of the year. When you go to the balance sheet, that is a true snapshot. If you have your own financial statements handy, you'll see that on the top of your statement, it'll say as of, call it December 31st, 2023, if your year end was December 31st. So basically, the balance sheet is a snapshot because it is a frozen in time on that day. Where is your bank account at? What is your loan balance at? What do you owe to these people? What is owed to you, perhaps? So it's a freeze frame. It's like if you get your credit card statement, it's always as of this date. So that's a freeze frame in time. Whereas the rest of the statement would say what happened during that time frame. So a credit card statement, the balance would go to the balance sheet. The transactions would be summarized in the income statement. I hope that maybe helps clear things up a little bit.
Yeah, no, for sure. That's very helpful. Next question. I wish the next generation could be here for this session. How should I get them financially literate? I learned old school, and luckily I'm here to tell the story, but how should I have them learn this?
There's a lot of ways. So you can there's lots of available, content online, including this webinar, obviously. There's lots of resources, whether it be through, I know a lot of universities run some little things as well, but also including them in the meetings when you're going to see the accountant, right? Then they can ask questions. What does this mean? What does that mean? And let's be honest, if you go into that meeting with the accountant, there's gonna be a lot that goes over our head, right? But just being exposed to the jargon, the discussions that happen around how the financial statements interact with what we know is going on the farm. I would say get them involved with as many conversations as you can surrounding these, and also push them to get some external learning as well.
One other thing that I see that a lot of people are doing is there's lots of accounting software now that's more app-based. You can take pictures and do it all on your phone. And so I'm seeing a lot of the next generation getting a little bit more involved in the day-to-day record keeping, just because they're a little bit more comfortable and they often lean towards that. And it's a great entry point. It can be corrected. If you make a mistake, you can go back and fix it, but it gives you a little exposure on the day-to-day to see where the records are.
Perfect. Thanks, Colleen. Next question. Are EBITDA ratios considered for startups or for businesses in the very early stages?
That's a good question. I mean, the whole point of EBITDA is to understand what's available at the end of the day. It's not necessarily just a profit thing, but to answer your question, and in our sake, in agriculture, it's important for both, right? If we see a new venture, the bank wants to know that it can pay for its debt, right? So if the bank is going to give you a loan, hey, I'll be honest, I don't own any farmland. I don't. So if I went to the bank and said, hey, I want to become a farmer tomorrow, there's a nice farm up for sale, and say it's $5 million, and I have a bit of a down payment, and they say, okay, well, what do you think? Is it going to cash flow? Can you pay us back? So from a startup perspective, it's insanely important that the bank is able to recognize, well, is this operation going to be able to pay their payments? From an existing operation, it's also important for that EBITDA number to be there, so they understand, well, is this operation making money, right? And are they able to service their debt? So EBITDA is not exclusive to a new and old, expanding. Everybody basically the bank will always be curious of what's available to service debt and what's kind of there. And if that operation isn't generating cash to be able to pay for things, then that's a different discussion that needs to happen.
We got a few questions that just come in, so perfect. Should I be looking at the ratios every year and comparing them, or the financial statements, or both?
Both, absolutely. I mean, you don't want to get lost. I don't want to say lost in the sauce, but paralysis analysis is a very real thing, right? I would say what is important to your operation in your industry, pick a few, right? So I would say always take a look at current ratio and your working capital. Understand your debt service ratio, so you're kind of always on top of, well, are we okay? Are we not? It kind of provides a bit of a red flag test right away. And then in terms of year over year, you can kind of start to look at, okay, well, how am I doing? What did we do to get maybe a stronger current ratio? And the ratios aren't necessarily just unique to the balance sheet. I kind of covered them really quickly, but if I go back a few slides here, these are ratios as well that operationally, these are what you can benchmark yourself against. So we spend a lot of time looking at gross margin, because that's kind of the most comparable area farm to farm. So really at the end of the day, if you're a dairy farmer, your feed over revenue ratio might be one of the more important ones to you, because you want to know am I spending the right amount on feed to produce the right amount of revenue? Or if it's way out of whack, what's wrong with my feed plan? Or all these metrics just basically allow you to identify areas to focus on. So depending on your operation type, you might hone in on, on grain. You say, okay, what's my gross margin per acre? That's kind of the be all end all. But as you get into livestock, there's different metrics of efficiency metrics that might be unique to your industry that you can look at year over year or month over month or what have you. I know in Manitoba, at least the statements look a certain way. When you ship a flock of birds, typically you get, how many were placed, how many were sold, what wasn't accepted, and then kind of your feed company might provide you with a flock report for what was sold to you in feed. So you kind of have all the tools available to you to be able to run these numbers and say, okay, well, how do we do this time? Okay, how do we do the time before that? How are we going to do next time?
Next one is specific to dairy, and the answer you may give might be it depends, but I'm going to give it to you anyway. So how high is too high for debt per kg of quota in a dairy operation?
That's a tricky one. So I know we have some team members on our team who are definitely dairy specialists, and Colleen might be more fluent than I am. But really, think about in your area what 1 kg of quota can produce in terms of dollars, right? And so really there is a bit of a kind of a range, but essentially, if you can't service the debt, that is where the problem starts. Colleen, do you have anything to add to that?
Yeah, I think the other thing to consider is kind of if you're using that internally or if you're looking at new lending. I know different banks will lend different amounts when you're looking to purchase quota. And really this is just meant to be a little bit of a leverage analysis to say, you've invested in buying quota, and is it generating you funds annually? And is it not paying for itself, but is it adding something to the bottom line? So it's really looking at that kind of return on quota and how much debt would be there if you were to kind of turn around and maybe either sell your quota or look at operations. It does help you analyze your leverage in that regard. The other thing I would just consider is a lot of these ratios sometimes just give us more insight into what's going on. So if you just expanded and you bought a lot of quota and you finance that, well, your debt per kg of quota is going to change drastically from the year before. That doesn't mean things are bad. It just means there's a little bit more digging that we have to do or storytelling behind the metric. So ratio is not necessarily good or bad. They just might be indicative of something that's going on in the farm that we can shine some more light on.
Well, I think that's the value of these ratios is it's getting that number, but then it's also having the ability to understand it and explain it and talk amongst the management team of your farm, your business, to say, okay, what does this actually mean for us? Is that a fair assessment?
Absolutely. And that would go for all the financial statements as well. This is really a focus on what are you doing well, what areas can you improve on, and how can you make that better going forward?
Yeah, so I'll admit I pinged my teammate off the side here for a little bit of a general number. And he said that the number used to be around that, 40,000 a kg was unsustainable. With the higher interest rates, he's kind of seen that come down to 35,000 per kg. He would say kind of in the realm of normal is about 20 to 25,000 per kg. So it's anything like anything else you might own, right? So if your acre is worth 6,000 an acre, generally speaking, you probably don't want to be leveraged $6,500 an acre. Is that fair to say? And so it's about that rate, that kind of balance of, like Colleen said, how leveraged are you and can your operation handle it? It depends on kind of what your margin is, and every province is a touch different, but not a ton. But essentially, what we're looking at here is, can you service the debt? And for an operation, especially with quota, it's not really, you have other assets that also cost a lot of money, whereas the quota isn't like land where it's necessarily the asset that's producing your revenue. You need it to produce the revenue, but It's just, it acts a little bit differently that way. So yeah, good question.
Well, in this next question, I think you've maybe, we're right at our time there, but I'm going to ask this next one. I think you've almost answered it. So profitability is more than just net income. What else should I be digging into to see if I really am successful / profitable?
We spend in our role here with the farms we work with, we spend, I'd say, 90% of our time talking about gross margin. So that what's included in the gross margin is, well, your revenue minus your direct expenses. So I'll make it easy. For crop, we talk about seed, fert, chemical, crop insurance. We don't include fuel in there. We don't include repairs. That goes below. But really, it's what does it cost to put it to produce a bushel of grain? There's going to be all the other overhead expenses, but spend your time in the gross margin. That's where you can make your biggest impact. Because if you miss on the gross margin, chances are you can't make it back. Because you can't make money on a crop by saving on fuel costs. The money is made in what you put in and what you get off.
Colleen, any final comments?
The only other thing I would add is there's always some really great discussions around what am I going to do with my next $100, $1,000, $10,000, $100,000. So if you are looking at any large expansions or anything like that, it's going to be less relevant on the income statement, but you want to see what your returns are on a bunch of what you're doing. And it goes back to those projections. So the other thing I would say is, if you're on this call, you maybe have a great bank you're working with, and maybe you have some advisors that you're comfortable with, lawyers, accountants. By all means, feel free to reach out to them too. We spend our days doing analysis and looking at these, and so we can probably provide you with some focused discussion around your own specific numbers. So don't be afraid to reach out to your team on those.
Oh, for sure. Alex, do you want to go through any of your FAQs, or have we covered them? It's up to you.
I think we've covered most of it, to be completely honest. If anyone has any questions, they can definitely reach out either through FCC, your FCC people, or you can contact Colleen or I directly. If I believe our information was up, was it not, Colleen?
If it's not, Shayna has it at FCC. I'm sure you can reach out to your FCC person.
Yeah. So if anyone has any questions about today or need help going forward, just go through them and they can pass it along.
Well, with that, I think we're going to wrap up. I made a note here, Alex. I've never heard it called working capital as your war chest. I love that. That's great. I'm taking that one away with me. So thanks to you both, Alex, Colleen, for taking the time to spend with us over these last 5 sessions in the last 3 months. Really appreciate it. All of that information is available on FCC's website. You can watch them, rewatch them, share with other members of your business so that they can get as illiterate on these business strategy pieces as you are. I hope you have some takeaways coming out of this series. We thank you for spending the time with us. An evaluation form will be sent out to all of you. Please fill it out. Tell us what you thought about this, how we can get better, what to do on the next session. With that, I want to wish you all the best for the 2024, whether it be crop year, livestock year, whatever that looks like for you. Thanks very much from FCC, and we wish you all the best. Thank you.